Welcome to our deep dive into the future of dividends in a low interest rate environment. Over the past decade, interest rates have remained at historic lows, reshaping the landscape for investors and companies alike. In this video, we'll explore how these changes impact dividend strategies, what investors should watch for, and how companies might adapt their payout policies. Whether you're a seasoned investor or just starting out, understanding the evolving role of dividends is crucial in today's market. Let's begin by looking at the basics of dividends and why they matter more than ever in a world of low yields. Dividends are regular payments made by companies to their shareholders, typically drawn from profits. They serve as a reward for investing in a company and can be a significant source of income, especially when interest rates are low. In this environment, the appeal of dividends grows as traditional savings accounts and bonds offer minimal returns. Understanding how dividends work and their role in total investment returns is the first step to building a resilient portfolio. Next, we'll explore how low interest rates have shifted investor preferences toward dividend-paying stocks. Interest rates and dividends are closely linked. When central banks keep rates low, the returns from bonds and savings accounts decrease. This makes dividend-paying stocks more attractive as they can offer higher yields than fixed-income alternatives. Investors often shift their focus to companies with stable and growing dividends, seeking both income and potential capital appreciation. As we move forward, let's examine how companies respond to this increased demand for dividends in a low-rate world. Companies are aware of the heightened interest in dividends during periods of low interest rates. Some firms may increase their dividend payouts to attract and retain investors, while others might initiate dividends for the first time. However, not all companies are in a position to do so. The decision to pay or raise dividends depends on profitability, cash flow, and long-term growth plans. Next, we'll look at the sectors most likely to benefit from this trend and why certain industries stand out. Not all sectors are created equal when it comes to dividends. Traditionally, utilities, consumer staples, and healthcare companies have been reliable dividend payers. These industries tend to have stable cash flows and less sensitivity to economic cycles, making them attractive in low-rate environments. Technology and growth sectors, on the other hand, often reinvest profits rather than pay dividends. As we continue, we'll discuss how sector rotation can play a role in dividend-focused strategies. Sector rotation involves shifting investments from one industry to another based on economic trends and market cycles. In a low-interest rate environment, investors may favor sectors with strong dividend histories. This can lead to increased demand and higher valuations for these stocks. However, it's important to balance income needs with growth potential, as overconcentration in one sector can increase risk. Next, we'll explore the risks and rewards of chasing high dividend yield. Chasing the highest dividend yields can be tempting, but it comes with risks. Sometimes a high yield signals underlying problems, such as declining earnings or unsustainable payout ratios. These so-called yield traps can lead to dividend cuts and falling stock prices. It's crucial to look beyond the headline yield and assess a company's financial health and dividend sustainability. Up next, we'll discuss how to evaluate dividend safety and what metrics to watch. To determine if a dividend is safe, investors should examine key metrics like the payout ratio, free cash flow, and earnings stability. A reasonable payout ratio, typically below 60%, suggests that a company isn't overextending itself. Consistent free cash flow and stable or growing earnings also indicate a healthy dividend. By focusing on these factors, investors can avoid unpleasant surprises and build a more resilient income stream. Next, let's look at how global trends are influencing dividend policies. Dividend policies vary around the world. In some regions, companies prioritize steady payouts, while others focus on reinvestment and growth. Global economic conditions, currency fluctuations, and regulatory changes all play a role in shaping dividend strategies. As investors seek income in a low-rate world, understanding these international differences becomes increasingly important. In the next scene, we'll examine how currency risk can impact foreign dividend investment. Investing in foreign dividend stocks introduces currency risk. Even if a company maintains or grows its dividend, fluctuations in exchange rates can erode returns for investors. Hedging strategies and diversification can help manage this risk, but it's important to be aware of the potential impact on your income stream. Next, we'll discuss how inflation interacts with dividends and why real returns matter. Inflation can eat into the purchasing power of dividend income. In a low-interest rate environment, inflation-adjusted or real returns become even more important. Companies that consistently grow their dividends can help offset inflation's effects, preserving your income's value over time. As we move forward, let's explore the role of dividend growth investing in this context. Dividend growth investing focuses on companies that regularly increase their payouts. This approach not only provides a rising income stream, but also signals financial strength and management confidence. In a low-rate world, dividend growth stocks can offer a powerful combination of income and capital appreciation. Next, we'll look at some classic examples of dividend growth companies and what sets them apart. Dividend aristocrats are companies that have increased their dividends for at least 25 consecutive years. These firms are often leaders in their industries with strong balance sheets and resilient business models. Investing in dividend aristocrats can provide stability and reliable income, especially when interest rates are low. In the next scene, we'll discuss how to build a diversified dividend portfolio. Well-constructed dividend portfolio balances yield, growth, and risk. Diversifying across sectors, geographies, and company sizes can help reduce volatility and enhance returns. It's also important to regularly review your holdings, as company fortunes and market conditions can change. Up next, we'll explore the role of dividend-focused funds and ETFs in portfolio construction. Dividend-focused mutual funds and ETFs offer an easy way to access a diversified basket of income-generating stocks. These funds are managed by professionals who select companies based on yield, growth, and quality criteria. For investors seeking convenience and diversification, dividend funds can be an attractive option. Next, we'll discuss the fees and considerations involved in choosing these products. When investing in dividend funds or ETFs, it's important to consider management fees, tracking error, and fund structure. High fees can eat into your returns, especially in a low-yield environment. Comparing expense ratios and understanding the fund's investment approach will help you make informed choices. In the next scene, we'll look at the tax implications of dividend investing. Dividends are often subject to taxes, which can vary depending on your country and account type. Some dividends may qualify for lower tax rates, while others are taxed as ordinary income. Tax-advantaged accounts such as IRAs or ISAs can help maximize after-tax returns. It's wise to consult a tax professional to understand how dividend income fits into your overall financial plan. Next, we'll explore the impact of regulatory changes on dividend policy. Government policies and regulations can influence how companies pay dividends. For example, during economic crises, regulators may restrict payouts to preserve capital. Changes in tax laws or accounting standards can also affect dividend strategies. Staying informed about regulatory developments is essential for dividend investors. In the next scene, we'll discuss how companies balance dividends with other uses of cash. Companies can return cash to shareholders through dividends or share buybacks. While dividends provide regular income, buybacks can boost share prices and offer tax advantages in some cases. The choice depends on company strategy, market conditions, and shareholder preferences. Understanding this balance helps investors anticipate changes in payout policies. Next, we'll look at how economic cycles influence dividend decisions. Dividends can fluctuate with the economic cycle. During downturns, companies may cut or suspend payouts to conserve cash. In expansions, rising profits often lead to higher dividends. Investors should be prepared for these cycles and focus on companies with resilient business models. Up next, we'll discuss the importance of management quality in sustaining dividends. Strong management teams are critical for maintaining and growing dividends. Leaders who prioritize shareholder returns, manage risk effectively, and allocate capital wisely are more likely to sustain payouts through challenging times. Assessing management's track record and communication can provide valuable insights. Next, we'll explore how ESG factors are shaping dividend policies. Environmental, social, and governance (ESG) considerations are increasingly influencing corporate policies, including dividends. Companies with strong ESG profiles may attract more investors and enjoy lower capital costs, supporting sustainable payouts. Conversely, firms with poor ESG practices may face regulatory or reputational risks that threaten dividends. As we continue, let's look at how technology is changing dividend investing. Technology is transforming how investors access and analyze dividend information. Online platforms, data analytics, and robo-advisors make it easier to screen for quality dividend stocks and manage portfolios. These tools can help investors identify opportunities and risks more efficiently. In the next scene, we'll discuss the rise of alternative income strategies in a low-rate world. Interest rates at historic lows, some investors are turning to alternative income sources, such as real estate investment trusts, REITs, preferred stocks, and infrastructure funds. These assets can offer attractive yields and diversification benefit, but they also come with unique risks. Understanding the trade-offs is key to building a robust income portfolio. Next, we'll look at the role of fixed income in a dividend strategy. Even in a low-rate environment, fixed income investments like bonds can play an important role in a dividend-focused portfolio. They provide stability, reduce volatility, and offer a predictable income stream. Balancing equities and fixed income helps manage risk and supports long-term financial goals. Up next, we'll discuss how to adjust your strategy as interest rates change. Interest rates won't stay low forever. When rates eventually rise, the relative attractiveness of dividend stocks may decline and bond yields could become more competitive. Investors should remain flexible, regularly review their portfolios, and be prepared to adjust allocations as market conditions evolve. Next, we'll look at the psychological aspects of dividend investing. Dividend investing appeals to many because of its tangible, regular income. This can provide comfort and confidence, especially during volatile markets. However, it's important not to let emotions drive investment decisions. Focusing on fundamentals and maintaining a long-term perspective are key to success. In the next scene, we'll discuss common mistakes to avoid in dividend investing. Some common mistakes in dividend investing include chasing unsustainable yields, neglecting diversification, and ignoring company fundamentals. It's also easy to overlook the impact of taxes and fees. By being aware of these pitfalls, investors can make more informed decisions and avoid costly errors. Next, we'll explore the importance of ongoing education and staying updated on market trends. The investment landscape is always evolving. Staying informed through books, courses, and reputable financial news sources can help you adapt your dividend strategy to changing conditions. Continuous learning is essential for long-term success. In the next scene, we'll look at how demographic trends are shaping the future of dividends. Aging populations in many developed countries are increasing demand for income-generating investments. As more people enter retirement, the focus on stable dividends is likely to grow. This demographic trend could influence corporate payout policies and market dynamics for years to come. Next, we'll discuss how technology adoption among retirees is changing dividend investing. Today's retirees are more tech-savvy than ever. Many use online platforms to manage their investments, access research, and monitor dividend payments. This shift is making dividend investing more accessible and transparent, empowering individuals to take control of their financial futures. Up next, we'll look at the role of financial advisors in dividend strategies. Financial advisors can help investors design and manage dividend-focused portfolios tailored to their goals and risk tolerance. They provide valuable guidance on asset allocation, tax strategies, and navigating market changes. Working with a trusted advisor can enhance your investment outcomes and provide peace of mind. Next, we'll discuss how to set realistic expectations for dividend investing. It's important to set realistic expectations for dividend investing. While dividends can provide steady income, they are not guaranteed and can fluctuate with company performance and market conditions. Patience and discipline are essential for long-term success. In the next scene, we'll explore how to monitor and adjust your dividend portfolio over time. Regularly reviewing your dividend portfolio helps ensure it remains aligned with your goals and risk tolerance. Watch for changes in company fundamentals, payout policies, and market trends. Rebalancing and making timely adjustments can help you stay on track. Up next, we'll discuss the importance of reinvesting dividends for long-term growth. Reinvesting dividends can significantly boost long-term returns through the power of compounding. Many companies and funds offer automatic dividend reinvestment plans, DRIPs, making it easy to grow your investment over time. This strategy can help offset periods of low yield and build wealth steadily. Next, we'll look at how to handle dividend cuts and market downturns. Dividend cuts can be disappointing, but they're sometimes necessary for a company's long-term health. When this happens, review your investment thesis and consider whether to hold, sell, or replace the stock. Diversification and focusing on quality can help cushion the impact of occasional cuts. In the next scene, we'll discuss the outlook for dividends as interest rates remain low. With interest rates expected to stay low for the foreseeable future, dividends are likely to remain a key focus for many investors. Companies with strong balance sheets and sustainable payout policies will be in high demand. However, competition for yield may drive up valuations, so careful selection is more important than ever. Next, we'll explore potential risks to the dividend landscape. Potential risks to the dividend environment include economic downturns, regulatory changes, and rising interest rates. Companies may also face industry-specific challenges that impact their ability to pay dividends. Staying vigilant and flexible will help investors navigate these uncertainties. In the next scene, we'll discuss the importance of aligning dividend strategies with personal financial goals. Every investor's situation is unique. Aligning your dividend strategy with your personal financial goals, time horizon, and risk tolerance is essential. Whether you're seeking income, growth, or a balance of both, a tailored approach will help you achieve your objectives. Up next, we'll look at the role of patience and discipline in successful dividend investing. Successful dividend investing requires patience and discipline. Markets will fluctuate and dividends may rise or fall, but sticking to a well-thought-out plan can help you weather the ups and downs. Avoid making impulsive decisions based on short-term events. In the next scene, we'll summarize the key takeaways from our discussion. In summary, dividends remain a vital source of income in a low-interest rate world. Focusing on quality, diversification, and sustainability can help you build a resilient portfolio. Stay informed, review your strategy regularly, and be prepared to adapt as conditions change. Next, we'll look at some resources for further learning. There are many resources available to help deepen your understanding of dividend investing. Books, online courses, and financial news outlets can provide valuable insights and keep you updated on market trends. Continuous learning is key to staying ahead in a changing environment. Up next, we'll provide a brief recap of the main points covered in this video. We've covered the basics of dividends, the impact of low interest rates, sector trends, portfolio construction, and the importance of ongoing education. Remember, successful dividend investing is about more than just chasing yield. It's about building a strategy that fits your needs and adapts to changing conditions. In our final scenes, we'll look at the future outlook and offer some closing thoughts. Looking ahead, the future of dividends in a low-interest rate environment will be shaped by economic trends, regulatory changes, and evolving investor preferences. Companies that prioritize sustainable payouts and adapt to new challenges are likely to thrive. Investors who stay informed and flexible will be best positioned to benefit from the opportunities ahead. Let's conclude with some final thoughts. Thank you for joining us on this journey through the future of dividends in a low-interest rate environment. By focusing on quality, diversification, and ongoing education, you can build a portfolio that stands the test of time. Remember, the investment landscape will continue to evolve, but the principles of sound dividend investing remain as relevant as ever. Wishing you success on your investment journey.